lesson 12. This one is about inflation, and this time you're going to see Ethel. So when you see Ethel, click for help. So here are the stepping stones for the inflation lesson. First of all, we need to know what inflation means. Then we're going to build on that to know how the basket of goods actually determines inflation. So if we jump straight over to key vocabulary, we're going to look at what the basket of goods are. And then we're going to be able to explain how the changes in inflation impact on retailers and consumers. So we can look at, for vocabulary, obviously it's inflation, making sure we know what the term means. We've got that extra term basket of goods, which we'll come on to straight away, and disposable income definitely is part of this lesson as well. Now, you'll know when you finish the lesson and you've successfully completed it, when you'll be able to write a statement, write a definition of inflation, that you can describe how we get the inflation rate from changes of the prices of products and services in this basket of goods, and then for an explanation on the increase or decrease of what happens when inflation changes to retailers and consumers. The careers at the bottom are tax related, as we're very much in that arena with these current topics. Your work list for inflation lesson 12, you've got 6 tasks to do. First one, we're looking at the purpose of the basket of goods, then the contents of the basket of goods, consumer pay rise, tasks for consumer spending habits, 5 spending habits which impact on retailers, and number 6, external factors. Inflation. Inflation is the rate at which the general level of prices is rising. The government measures inflation through the use of regular pricing of a basket of goods. This basket of goods is meant to reflect the spending habits of the average person within the UK and includes over 600 goods and services. The basket contains such things as petrol, cars, travel, holidays, consumer electrics, food, medicine, housing, and even lottery tickets and online dating. By judging and measuring the difference in the cost of purchasing this basket of goods monthly, we are able to obtain an inflation figure. The target rate of inflation is known as the Consumer Price Index, CPI. Inflation is usually shown as a percentage, for example 2%. If inflation is currently 2%, it means that prices are 2% higher than they were this time last year. A basket of goods bought last year for £100 would today cost £102, even though the goods bought are identical. The UK has experienced relatively low levels of inflation for the last 18 years. Inflation varies between 0% and 5%. Your question. Number 1. Why do they monitor this basket of goods? So we want to look at the second paragraph. We're looking at what the basket of goods is monitoring. We're looking at the spending habits and what is it that we're trying to gauge by looking at the cost of the basket of goods. What does inflation mean for retail businesses? Businesses need to purchase a variety of materials as well as energy, water and premises in order to run their business. If the inflation rate is above 0%, it means that costs are rising. For example, a clothes retailer will have to pay more for the clothes it purchases and the energy it needs to power its shops. A pay increase for company employees may also be required. Your question, question 2. What goes in the basket of goods to monitor inflation? Now you might have to flick back to the last slide to double check, but here in the answer you're going to write a list of some of the items that go in the basket of goods. What does inflation mean for retail businesses? If costs are rising, most businesses will want to increase their prices so they can keep a certain level of profit. Under normal circumstances, if a business raises prices, then consumers would simply shop elsewhere. However, inflation affects all businesses, and so they're all raising their prices. Consumers do not have the option of shopping for cheaper goods elsewhere. So inflation can mean that disposable income is reduced for all consumers. As a result, Businesses may face demands from workers for higher wages as they need more money to pay for the rising cost of goods and services. Consumers, businesses and governments do not want inflation to increase too much. The government has a target of 2%. At this rate, inflation will not have a negative impact on the economy. The current rate of inflation is 1.7%. Your question, number 3. Do consumers always get a pay rise if inflation increases? The answers are from the text on the left. So if we look at, say, the 4th paragraph, businesses may face demands from workers for higher wages so they can afford the rising cost of goods and services, but do they always get it? Number 4, how will this impact their spending habits? So we're talking about if they get a pay rise, if inflation increases. So if they don't get a pay rise and inflation increases, what happens to spending habits? If inflation increases and pay rises increases, what happens to spending habits? So you've got both ways round to consider for your answer. And question 5, how will this impact retailers? So if we've got a rise in inflation and a rise in prices, then they want to make sure they keep a certain level of profit, because after all, they're in business and they need to pay their bills, they need to pay their own employee wages, and they need to probably, if they're a business owner, take their income from the profit. But what do? Do they pass on the prices to consumers? Then they've got to look at what's going on with the competitors. All these things play into what happens with a rise in inflation. And if there is a rise in inflation and people's wages don't go up, then that could negatively impact spending habits, which means these retailers don't get as much purchases in their shops. So then what happens to the shops? So all these things are going to have an impact for retailers as well, that you need to note down in number 5 box. External factors influencing retailers. Retail businesses are affected by factors over which they have no control. These are external factors. Number 6. Explain how each of the following might affect retail businesses in the UK. Question A. An increase in interest rates. Now that's where we might have to go back over to lesson 11 and look at what happens to interest rates. If there's a rise in interest rates, what's going to happen to the cost of borrowing? The cost of borrowing for the business and the cost of borrowing for consumers. Question B. A decrease in unemployment. If there's a decrease in unemployment, there's an increase in employment, which means more people are employed, which means these people have more income. If they've got more income, what happens to spending habits? A sharp increase in inflation. Now notice this says sharp increase. If inflation suddenly goes up, then that means the price of goods, remember that's the basket of goods, all those goods specifically are going to go up in price. What's going to happen to people's income? Are they going to also have a sharp increase in wages? Probably not. So what's going to happen to their ability to spend? And the last question, an increase in consumer disposable income. Now remember, disposable income is the amount of money a consumer has after they've paid their taxes and their bills. So if they have an increase in that disposable income, then they've got more money to spend. So what do? What's the impact on retailers? Well, that's it. You've completed lesson 12, all the 6 tasks on inflation. Well done. We've got the basket of goods, consumers' pay rise and spending habits, and the impact of on retailers. And let's not forget the external factors for task 6. Well done.